Historically, over time, when societies have become indebted like this, there's two ways out. There's a good, honest default, where the government says to the bondholders, too bad, so sad, we're not going to pay. And where they say, the young generation says to old generation, like me, well, you voted yourself all these benefits, you pay for them.
Hi, I'm Ken Lewis, CEO of APMEX Inc. and OneGold. Here today with me is Rick Rule, and we're going to talk a little bit about why you should own precious metals. So Rick, I've got twin boys. They're about to graduate college here soon. Naturally, I like to give my kids advice on investments, to think about it at a young age. Is there anything you would share with my children as they start out in the professional world and how to think about retirement planning and thinking about it early?
I've thought about this a lot. I do, as you may know, a lot of youth mentoring. It's one of my philanthropic activities. And separate and apart from that, obviously the millennials are the future of our business. Talking to the millennials, I think, is important. You know, your kids grew up in one of the most benign investment climates on the planet.
That's a good point. The
market went up, interest rates went down, property went up. If you basically were able to walk and chew gum and stayed in the market, you did okay. Mm-hmm. But my suspicion is that the future, while still bright, is going to be somewhat less benign. And I think, unfortunately, what you and I, more my generation than your generation, has done to our kids is substantially less benign. Well, the kids react to narrative. We have to teach them some arithmetic. And the arithmetic goes like this. At the federal level, on balance sheet, our obligations exceed $22 trillion. Off-balance sheet, by the way, off-balance sheet obligations, your viewers are looking at them. I'm 67 years old. Medicare, Medicaid,
right.
All these things. Those liabilities are $100 trillion. Now, when I say trillion to audiences, their eyes glaze over. They don't know what a trillion is. It's a boring concept because they can't recognize it. Well, it's 12 zeros to begin with. Yeah. The point of all this is that federally, we owe each other $120 trillion. That's the debt. How are we going to pay the debt off? Well, this is another problem. The budget, or national income, taxes and fees less expenses, are $1 trillion a year upside down, right. Meaning that we aren't paying it down, we're actually building the debt up. Young people need to think this. How do you add a column of negative numbers and come up with a positive sum? And they need to understand that while we're leaving them, in many ways, a good world, the other thing that we're leaving them is a $120 trillion bill for benefits that we voted for each other, but we're leaving them the bill. Historically, over time, when societies have become indebted like this, there's two ways out. There's a good, honest default, where the government says to the bondholders, too bad, so sad, we're not going to pay. And where they say, the young generation says to old generation, like me, well, you voted yourself all these benefits, you pay for them. But that isn't what happens politically. Politically, what happens is that you lessen the value of the obligation. In other words, you lessen the net present value of the currency. The reason I say this is not necessarily just to criticize government, but rather to say, over 3,000 years, the best form of insurance against the depreciation of a currency by society has been gold. And the need today is as great as it's ever been.
So if you were a young man, 22 years old, 25 years old, and you were looking to start your investments, and you had $100 to put away a week, how do you think an individual should go about gold in terms of ratios or views, or is that just too generic of a question?
No, I don't think it's too generic. I think partially it depends on the subject's means and how much risk he or she is willing to take.
Right.
But I believe, as a sort of a rule of thumb in systematic savings, that 10% is probably an adequate allocation to gold. There are some people who are more aggressive and hence need to own less gold. From my own point of view, it's interesting. I don't want anybody to conflate me with a 20-year-old, which is probably not going to happen. But the truth is, when you think about the fact that I'm an example, the largest shareholder of Sprott, my life is wrapped around gold, but I still own a lot of gold. And I own gold because I like to be liquid. I know that during tough times, if I have liquidity that I can take advantage of the situation rather than being taken advantage of. Gold and cash helps me sleep nights and stay calm. And I suspect that a 20-year-old today, assuming that that 20-year-old lives to be, let's say 80 or 90, he or she will experience 6 or 7 or 8 liquidity crises, market declines in his or her career. If you have liquidity, particularly if you have good liquidity, physical precious metals, you take advantage of the situation rather than being taken advantage of.
Right. Good points. One of the things that I've always looked at is what you have kind of off the grid, what you have, if you will, that you can touch. And I've always found as I'm getting older, wealth preservation becomes more important to me. As you think about having assets offline, what are your views on that? Is it something where your personal opinion is you don't keep it in the home necessarily? Do you feel like you keep it in a third-party holding facility? Do you feel you just better to own another option out there? What's your view on that?
This is my personal opinion, not the Sprott opinion. I have a lot of clients who have engaged in what I call midnight gardening. Which is taking the physical home. I don't recommend that. I have a friend and a client, 2 different people, who, as a consequence of having physical precious metals at home, have been visited by people that you and I wouldn't invite to lunch. And I think that you substitute one set of risks for a very different set of risks. So my own, I'm not speaking on behalf of OneGold or Sprott, I'm speaking on behalf of Rick Rule. My preference for my friends and customers that own physical precious metals is that they eliminate that risk by storing it somewhere. Your facility downstairs with all the security you have in place and 3-foot thick doors seems like a good idea to me.
Yeah, one of the things we've rolled out, it's been probably 8-9 years ago, is an arrangement with Brinks where we actually offer storage to our clients where they can store their eagles, their maples, and bars. And actually we bill them a small storage fee, but you get insurance, you get protection, you get peace of mind knowing that metal is going to be there.
Certainly I have clients that really want to be offline. They want their own physical precious metals. And when I talk to them, they say, thank you for my opinion, I'll do it my way, which is fine too. You just asked me.
Right. Well, look, we're one of the largest physical metal dealers in the world. And we find most of our clients actually prefer to have it come to their home. Now, how they store it in their home, would they have safes or do other things with it is really their discretion. But we do find a lot of people do like that. And I think some of the reasons why they like that is they look at it as ways to kind of know they have assets that others aren't aware of necessarily, or a way to pass on inheritance within their family, or just a way to kind of manage their net worth in a more conservative fashion. So I think it really depends on the individual. I think you would agree on what works best for them.
I would, Ken. I would say that I'm sympathetic to home storage and empathetic to secure storage.
Yeah, good points. So Rick, look, you've kind of progressed in your career. You're in your 40s, 50s, early 50s. You got a net worth that you really feel proud of. You're confident in that, in your ability to earn more income over time. You're looking to invest. How does a person approach investments, at that point in their life, from your perspective?
Partly it's a function of the rest of your portfolio. As an example, to the extent that someone's savings was largely in long-term bonds, which can get massacred by inflation, then you have a higher proportion of gold ownership. As one ages, as one becomes wealthier, as one becomes more financially secure, the need for insurance remains. In fact, you find that people buy other types of insurance in increasing amounts as the insurance becomes affordable. The second thing that happens is the function of precious metals within your account goes from being merely insurance and liquidity, which it was when you were young, to being an investment and even a speculative asset. The bedrock, of course, is physical gold. But as one ages and you're looking for investment performance, in down markets, physical silver over time outperforms physical gold. It's more volatile, so it becomes a speculative asset. The second thing that can occur is at that point in time, it becomes efficacious to invest, buying very, very, very high quality precious metals mining shares as an example, or with more speculative money, silver, high quality silver mining shares. So as your means progress, the way that you consume precious metals grows. But it doesn't change. The truth is, ultimately, that insurance stays an important part of a prudent portfolio throughout one's life.
Yeah, no, one of the things that I focused on more recently is thinking more about wealth preservation rather than necessarily wealth gaining or growing the wealth. And you think differently sometimes, a little bit about that. And I think some of the aspects of how you would invest in metals is a good example of that. Maybe how much cash you're willing to have, maybe how much real estate you want to hold in terms of your portfolio. You start to move your assets around to be, in many views, more conservative in some natures, just because you're trying to preserve wealth and not see that it, in a down market, could disappear so dramatically.
You make a good point. One of the interesting things about gold is the price volatility in gold actually makes it a fairly efficient form of insurance. If you look at the decade 2000 to 2010, at the beginning of the decade, confidence in the economy was extraordinarily high, and gold sold for $250 an ounce. Someone who would have put, say, 10% of their net worth in gold would have seen six-fold appreciation over the course of the decade. The equity markets did well, but let's assume for a second that the equity markets didn't do well. Let's assume that that decade looked like the decade, of the 1970s, where common stocks fell by 25%. The truth is that a small holding in gold, 10% of one's portfolio, would have more than hedged out all of the losses that they expose themselves to in other parts of their portfolio. That's really the beauty of gold. When times get tough, a little bit of gold goes a very, very, very long way. That isn't to say that people who have an opinion about price need to use it just as insurance, because certainly six-fold appreciation made it a very good investment asset too.
Right. Yeah, I've always quoted this. Actually, I think I used a 20-year horizon. You used a 10. But 2000 to 2020, it's the second best performing asset class you could have been in, even outperforming the S&P 500. So sometimes people think gold is a safe haven or a conservative investment. The reality is it's actually performed very well over the last 20 years.
Right. If one wants it as an investment class, one must have very, very, very long time horizons.
Correct.
Perhaps I'm talking as a person who's been successful in several businesses. So from my own personal point of view, the way I sell it well, I regard it as an insurance class, but certainly what you say is true.
Well, I think your length of time of ownership is a very good point as well. I think people who tend to get into metals tend to be into them for a longer period of time. They're not looking to be in and out and in and out like you might find in equities, because frankly they're thinking for the long term. And gold today is going to be a good investment 10 years from now like it is today.
That's my personal belief. As I say, I regard it as an insurance class, but I understand what you say.
Yeah. Okay, Rick. Man, time's flown by. I'm getting close to retirement, and naturally, I'm looking at my investments. I'm looking at my assets, and I want to make sure I'm doing the right thing, not only for myself but for my family long term. And I want to kind of get your thoughts on how you look at that from your perspective.
Again, Ken, it depends on the retiree.
Yeah.
What we find as people age and as their investments become allegedly more conservative, they become much more interest rate sensitive, which means they tend to go to deposit products and they tend to go to bonds. Yeah. And those are precisely the assets that will do very well for you until they don't. Yeah. And during the points in time when they don't, gold again forms a wonderful insurance function. A pure financial planner would probably say that you need less insurance as you age because you're wealthier and the time that you're trying to defend your purchasing power for decreases. But the truth is that people's psychological need for security increases as they age. And the truth is, and this is personal again, I'm not speaking as Sprott, I'm speaking as Rick Rule. The essence of wealth, Ken, is enhancing your sense of well-being. So when you're talking about an aged person close to retirement, you're looking at one. And the truth is, as I say, physical precious metals and cash, liquidity, help me sleep nights and stay calm, which is important to me.
Yeah, no, I think that's a great point. And, it's one of the things I recently gave a presentation talking about inflation and kind of what it does to the dollar over time. You need to have a natural certain amount set aside for the rainy day. But can you talk a little bit about gold and the dollar and how to think about them in tandem?
I have a great anecdote I'll give that your older viewers will appreciate. When I was a young man building my business and I was on a very, very stringent budget, it's a fancy way of saying I was broke, I had occasion to stay at a well-known lodging establishment nationwide called Motel 6. Most of your viewers will be familiar with Motel 6. It was called Motel 6, Ken, because a room there cost $6 a night. On my way to the office in Carlsbad, California yesterday, I went past a Motel 6, and the sign said Motel 6, $64.99, which is to say Motel 60. Now, there's only two possible explanations for this, Ken. Perhaps you can help me. Either today, a room at Motel 6 is 10 or 11 times as spacious and 10 or 11 times as luxurious. You certainly couldn't tell that from the exterior of a Motel 6. And I will admit I haven't done much recent due diligence. Or the denominator. The purchasing power of the medium of exchange used to purchase a room at Motel 6 has declined by 95% in the last 35 years. Right. The best illustration that I have for Americans of my generation with regards to the purchasing power of gold is my daily trips past Motel 6, an institution that I have firsthand knowledge of. You know, when our government talks to us about the decline in purchasing power of the US dollar, they use a consumer price index. And the consumer price index is a fairly interesting collection of data. In the first instance, whoever compiles the consumer price index doesn't shop where I shop. The other thing about the index, and this is amazing to me, Ken, they don't include tax. Now, my cost of living, in fact, includes tax. So any compilation of my cost of living that doesn't include tax becomes fallacious. They also give me hedonism credits. Now, I really wish I was more hedonist, but it seems to me that they are telling me that my cost of living increases by 1.6% a year. I don't buy much. I'm a cheapskate. And I would say anecdotally that my cost of living ex-tax increases by 4 or 4.5% a year. Now, think what happens if you have $100,000 in the bank and the purchasing power of that $100,000 declines by $4,500 a year after 10 years. What it means is that half of your purchasing power went to money heaven, pre-tax. So let's think about the alternative for savers to gold. The world's benchmark security is the U.S. 10-year Treasury. It's the security that every other security in the world is priced off of. It's denominated in U.S. dollars, which are the reserve currency of the world, the highest and best use of money on the planet. The government tells us right now that they are going to pay us 1.68, I think, as of this filming, for the U.S. 10-year Treasury. That means that you're going to give the U.S. government money, and they're going to give you 1.68%. in a currency that they say is depreciating by 1.6%. In other words, they're going to give you 0.8% a year for 10 years. My good friend Jim Grant calls that return-free risk. Return-free risk. It is, in one sense, the most stable investment in the world. If you give them money, this is the only promise our government may ever keep. They absolutely promise to give you back less than you gave them.
Yeah, well, I think that actually makes a great point why you should hold gold as well.
Right.
And I've talked to many a person talks about holding dollars, and I try to educate them on inflation. I think your overview there is a good one. And
I believe you have to have dollars short term.
Yes.
You have to have short term liquidity. You absolutely positively have to. These ideas,
Sure.
people who want to be only in gold, I think, is making a mistake. But the truth is that most people have no gold whatsoever, and
Right.
most people believe that the U.S. 10-year Treasury is a good investment.
Right. No, I agree 100%. Yeah, that's a good point. One of the things I've been thinking a lot about is where precious metals fits in the fold, right? And you can go out and look at it from a diversification standpoint. You can go out and look at it from interest rates and are they attractive for investments today. You can go out and look at it from concerns about the dollar being printed at all-time high rates. But at the end of the day, it seems like any way you look at it, it seems positive in having some exposure to precious metals in your portfolio any way you slice it.
Well, I think that's accurate. irrespective of your outlook, but I think particularly in the context of people examining the way they feel today relative, if they're older, to the way they felt in the decade of the 70s, or the way they felt in the tech wreck of 2000, or if they're old enough, how they felt in 2007. During periods of time of instability, during periods of time when your confidence gets challenged, gold traditionally has done very, very well.
Yeah, we were looking at 2007 and 2008 recently and looking what the equities markets did on the pullback and just how well precious metals performed. And it just reminds you that it acts as a hedge, a natural hedge to equities.
It's important to note that in a very sharp, liquidity-driven decline like 2008, gold sells off too. Because the liquidation decision isn't made by the investor, it's made by the margin clerk. But it also comes back more quickly. People who were prudent, who went into the circumstance with liquidity, who are looking to park surplus cash into an asset that will sustain and support their purchasing power. During periods of trust, people go into gold. Remember, and I know you remember because you sell it every day, gold is a medium of exchange and a store of value simultaneously. A dollar is a promise to pay. Gold is in fact payment. You don't have to trust anybody because it is payment. It's not a promise to pay. And in the aftermath of liquidity-driven circumstances, demand for gold is very high for just that reason. You don't have to trust anybody.
Yeah, and one of the things we've seen in our business is, obviously with the equities markets doing very well, consumption of physical metal is not quite as high. But we've seen ETF flows in the past year actually be at very high levels, I think even dating back several years in terms of the amount of inflow. Why do you view inflows into ETFs when the physical demand side hasn't quite kept up quite yet?
I think a lot of people are holding physical assets now in system. Wall Street is very good at monetizing demand, and Wall Street has figured out that there is demand for physical precious metals, and the fact that somebody can go to Merrill Lynch or Schwab and hold their precious metals in the same place that they hold their equities and their bonds has made life very easy. Now, I'll share an interesting statistic with you about that. And I forget what bank published this, but fairly recently, I read that precious metals and precious metal securities nationwide comprise between 1/3 and 1/2 of 1% of investment and savings assets in the United States. If you go back to 1981, which was the peak of gold demand, as I understand it, precious metals and precious metals related investments had a 7% market share in savings and investment nationwide. And the 3-decade median is between 2 and 2.5%. Now, I'm not one of these who suggests that gold is going to supplant the US dollar as a medium of exchange. I don't think gold's going to win the war against the dollar. But I bet you it's going to lose it less badly. My belief is, in terms of things like the ETFs and the precious and the whole panoply of precious metals investments, that gold demand, precious metals and precious metals assets demand in the United States will go from its current level, less than 1/2 of 1%, to its 30-year mean, which is 2%. Mean reversion generates a 4-fold increase in market share for precious metals and precious metals related asset in the largest investment economy in the world. And that's what I think is going to happen.
You know, one of the things we talked about at lunch today was the upside versus the downside risk of something like gold. You know, you look at where pricing is today, you look at where it is historically, you look at where, only a certain amount of gold is coming out of the ground at any given year and where mining is on that stage. It seems to me like gold has a far lower downside and a much greater upside. Any views on that?
Ken, you're going to hate this answer. Pray for a downside. I mean, a downside means that no insurable event occurred. Wouldn't it be great if your kids had life insurance on you and they never got paid?
Great point.
Which meant that your great-great-great-grandchildren could enjoy your company. Think of automobile insurance that you never collected on, which meant you never had a wreck. Think of insurance on your house that you never collected on, you never had a fire. I own a lot of gold. And I hope the stuff goes to $400 or $500 an ounce. What it means is that everything else in my life turned out fine. Yeah. By the way, I don't think that's going to happen. Yeah. But when you talk about the upside in gold, I always tell my clients, be very cautious what you think about. That set of circumstances that could cause gold to go to $5,000 an ounce or $12,000 an ounce, while they're certainly identifiable circumstances, they're uniformly unpleasant.
Right. Why should investors own precious metals?
As insurance, and during periods of time when the price feels depressed, for price appreciation. Yeah. It's worked for 2,000 years. My suspicion is it'll work for a while longer.
Should everyone invest in precious metals?
Everyone should invest in precious metals. The amount that you invest or the form that you invest in changes over time with your age and your means.
So why do high net worth individuals buy silver or gold? Why do they generally go into gold and silver? You always hear about them being at a higher rate into gold and silver. Any reason why you feel that is?
I think wealthy people have better access to information. I think that's how they got wealthy. All the wealthy people that I know read history, and gold does well in history. But wealthy people also have more to protect. Perhaps they became wealthy by being prudent when other people were less prudent.
That's a great point. That's a great point. Why is gold considered an effective hedge in the world today?
History. Gold is unique in that it's a widely accepted medium of exchange, but it's also a store of value. It isn't fiat. It can't be created with a keystroke. Right. It isn't a promise to pay. It's simply payment. You want a short answer, but I'm going to give you a long answer. The customer base at Sprott that I don't have to educate about gold are historically, as an example, Jewish people whose parents experienced Auschwitz. They're Vietnamese boat people. They're Palestinians who were thrown out of Israel. People who, in their experience or their culture's experience, have experienced trauma are not people who require a long-winded lecture from Rick about the efficacy of precious metals.
No, that's a great point. It's a great point. So Rick, what drives the price of gold and silver in today's markets?
In my experience, which is to say historically, gold moves first, and gold moves on fear. Because gold is so volatile, the fear buyer takes it to price level so quickly that the greed buyer steps in. And there's this staccato back and forth between greed and fear. Yeah. Silver moves later. Silver is the poor man's gold. So after gold has moved, silver responds. But because of its greater volatility and lower unit cost, it usually moves further. We suggest that gold is an insurance asset and silver is a speculative asset, and that customers treat them that way.
That's a good point. So Rick, dollar cost averaging. It's something I've heard about ever since I was in college. Of course, I didn't practice it very well when I was younger. It's something I try to drive home to my kids. But what's your view on dollar cost averaging, and how should people think about making investments?
Useful technique. What I encourage young people in particular to do is save. Yeah. Save 10% pre-tax of every paycheck before you buy your Starbucks. Save. Yeah. And some proportion of that saving should probably be in gold. That de facto becomes dollar cost averaging. The important thing isn't dollar cost averaging, though. It's saving. Right. To employ capital in the world, and we live in a capitalist society, you have to have some capital. Yeah. Save.
Yeah. No, I agree. And one of the things that I was looking at, I actually talked to my children about this recently, was setting up a process and almost forgetting about it. Example could be a 401k. Example could be setting up auto repeat investments. Any view on that? Just to kind of get your body in the motion of doing it, and then letting it go, and then of course revisiting it once a year or more frequently if needed.
Certainly, if that's what it takes.
Yeah.
The important thing is to save and to think about how your money is going to work for you. So dollar cost averaging, sure. Robo-investing, sure. Right. Whatever it takes for you is what's important.
One of the things that we're proud of on the OneGold platform, and you can only do this in the digital space, not so much as easy to do in the physical space, is we give consumers the ability to come onto our platform, decide they want to buy $50 in gold every month, set it up, set the end date for when they want that to end, let the funds automatically pull in from the bank account, and you're done. And the concept being that you'll accumulate some assets, some savings in gold, and the reception rate on that has been remarkable. 65% of all of our transactions are auto invest transactions. They're dollar cost averaging, and they're forgetting about it, which I think is a wise decision on our consumers' parts.
Absolutely. I actually think you're doing a public service. I'm not trying to say you aren't getting paid for it. But the fact that you are making a function easy that otherwise might be lost to procrastination is a wonderful thing.
Rick, one of the things we've talked about is the barriers of entry into metal, right? How easy or hard it is to get into metal. One of the things we're proud of at OneGold that we're trying to do is to make it simple, to make it easy, to make it straightforward, to make it transparent. Any views on your experience in investing in metal and how to make it simple for consumers?
Markets work. You are an example of disintermediating historic providers that were very inefficient. Right. I think it's wonderful. I have a high degree of confidence that OneGold isn't what it will ultimately be. Right. That you'll make it a little bit better every year. The market will demand it of you, and the fact that you've been successful so far suggests that you'll succeed in the future.
No, that's a great point. And I think staying committed to the consumer, keeping it simple, keeping it attractive for consumers in terms of features are the keys to being relevant in today's society with any fintech type investment you're doing today.
Correct. The fact that you guys created a phone app that a 67-year-old Luddite can make work is testimony to the technology you've created. It's great.
Thank you. So Rick, there's multiple ways of owning precious metals. I'd like to kind of walk through each one of these. And if you can give us your view on the process, maybe some pros and cons of each one of them, it'd be very helpful to our customers. So let's start with the old school way, physical, right? Physical's been around forever. What's the pros, cons, ways you go about owning physical today?
Well, the basis is physical. That's where everybody should start. And the way that people own it is of less interest to me. If they own it absolutely as physical, that's fine. If they own it as a physical ETF or if they own it as a trust, if they own certificated gold, that's fine with me too. That's where you start. When you move beyond insurance to investing, traditionally, one then invests in the very finest of the gold stocks. Companies that are chosen because of durability of free cash flow margins, the way you would buy any other stock. Right. And then, of course, there are the speculators who want to be in the junior mining stocks or in the very volatile instruments like the high-quality silver stocks. There are also, of course, instruments for equities like the ETFs and the funds. Right. Those have places too. That's really up to the investor. If they want the diversity of an ETF or the diversity of a managed fund, they have to understand that they pay a fee for that, which may or may not seem worth the fee to them.
That's a good point. One of the things that we've heard from customers is some like to control their own destiny. They like to be able to go on to their brokerage account or onto an APMEX.com or onto even OneGold today. But then some like to have advisors. Any view as to which is the right approach for a consumer?
I don't think so. I think that depends on your point in time in life.
Good point.
I encourage investors when they're young to have more control over their assets, not as an end in itself, but rather as a means of education. Yeah. One of the things that's happened to me later in life is that in some of the asset classes I own, I'm thinking of agricultural real estate as an example, I prefer to have an advisor because I don't want to stretch fence and I don't want to lease land to a farmer. I want somebody to do that for me. I have a day job and it's a pretty good job. One of the things that happens to you as you get older and wealthier and deeper in your own career, you find out that managing certain aspects of your financial career take so much time and effort that they make you less good at what you did to generate the wealth. But it's really an individual question.
Right, no, that's a great point. Well, Rick, thanks for coming in today. We do appreciate your time and all your insights.
Thank you for the conversation and thank you for the wonderful tour of your facilities.
Thanks.